The Federal Reserve just warned about rising leverage in financial markets while retail investors continue trading with borrowed money. That combination creates one of the most dangerous cycles in finance, because when leverage builds quietly, margin calls follow suddenly. And when margin calls begin, markets do not fall slowly. They fall violently. This is the margin call cycle. And it is one of the most misunderstood forces in financial markets. Retail investors often believe crashes happen because of bad news, a recession headline, a political shock, a corporate failure. But many of the most violent market drops are not triggered by news. They are triggered by leverage. Leverage is borrowed money used to amplify investment exposure. If an investor has $1,000 and uses leverage, that investor can control $5,000 or $10,000 of assets. If prices rise, leverage multiplies gains. But if prices fall, leverage multiplies losses. And when losses reach a certain threshold, something automatic happens. The broker issues a margin call. A margin call is not a suggestion. It is a demand. The investor must deposit more capital immediately, or positions are liquidated automatically. Now imagine this happening across thousands of accounts at the same time. One forced sale pushes prices lower. Lower prices trigger new margin calls. New margin calls trigger more forced selling. Selling feeds selling. The cycle accelerates, and suddenly markets collapse much faster than anyone expected. This is why crashes often appear chaotic. But the chaos is mechanical. It is not emotional. It is structural. Now look at what has been happening recently. Retail trading activity surged during the last cycle. Millions of investors entered markets during an era of easy liquidity. Low interest rates, cheap borrowing, high asset prices, leverage expanded across the system. Margin debt climbed to extreme levels. And during expansion cycles, this leverage feels invisible because prices rise, and rising prices hide fragility. But when liquidity tightens, fragility becomes visible immediately. Interest rates increase, credit conditions tighten, risk tolerance declines, asset prices begin to fluctuate more aggressively. And that is when leverage becomes dangerous, because small declines suddenly trigger forced liquidations. Now consider the structural advantage institutions hold during these cycles. Large institutions rarely rely on retail-style margin accounts. They have deeper capital reserves. They manage liquidity buffers. They structure risk exposure differently. When volatility increases, institutions reduce exposure slowly. Retail investors often increase exposure hoping for recovery. That difference becomes critical during a margin call cycle, because forced selling does not care about conviction. It does not care about belief. It does not care about long-term potential. It only cares about collateral. If collateral falls below required thresholds, positions are liquidated automatically. Now imagine thousands of traders holding similar positions, the same stocks, the same cryptocurrencies, the same leveraged bets. When prices drop, margin calls begin simultaneously. The result is a cascade. Charts show vertical drops, but those drops are not random. They are liquidation events. This is why crashes accelerate, because selling becomes mechanical, and mechanical selling overwhelms natural buyers. But here is where the power dynamic appears. While forced selling pushes prices lower, another group of investors waits. Investors with liquidity, investors with patience, investors without margin pressure. These investors do not panic. They observe, they analyze, and they prepare. Because during liquidation cycles, assets often fall far below their intrinsic value. Healthy companies become discounted. Strategic assets become cheap. And investors with liquidity can acquire them. This is how wealth transfers during crises, not through luck, through positioning. Those forced to sell transfer assets to those able to buy. That is the margin call cycle. Weak hands liquidate, strong hands accumulate. Now think about what happens psychologically during these events. Retail investors see prices collapsing. Fear spreads rapidly. Social media amplifies panic. News headlines reinforce instability. But the real driver is not fear. It is leverage unwinding. By the time panic becomes visible, forced selling has already started. And that is why markets often drop faster than anyone expects. Because liquidation is not gradual, it is sudden, and it compounds rapidly. Now connect this mechanism to what we discussed earlier. Central banks accumulating gold, institutions raising cash, liquidity tightening across global markets. These signals do not guarantee an immediate crash, but they increase the probability of leverage stress. And leverage stress creates margin calls. Margin calls create liquidation waves. Liquidation waves create opportunity for those prepared. This is why experienced investors focus so heavily on liquidity. Liquidity is survival during volatility. Liquidity allows patience. Liquidity allows buying when others must sell. Without liquidity, investors become trapped. They watch opportunities appear but cannot act because their capital is locked, or worse, because their positions are being liquidated. This is the hidden structure of market cycles. Expansion builds leverage. Leverage builds fragility. Fragility collapses under stress, and collapse transfers assets to those positioned correctly. The margin call cycle is brutal, but it is predictable. And right now, the ingredients that create it are beginning to appear again: rising volatility, tightening liquidity, high leverage exposure. None of these forces cause immediate collapse on their own, but together they build pressure. And pressure eventually finds release. When that release happens, the headlines will focus on fear, but the real story will be mechanical liquidation. And once that liquidation wave begins, markets will not wait for investors to feel ready. They will move quickly, because forced selling never moves slowly. If understanding these hidden mechanics helps you see markets differently, consider subscribing, because the next phase of this cycle will not start with headlines. It will start quietly, and the investors who recognize the signals early will have the advantage when volatility returns. Now look deeper at how this cycle actually begins. It rarely starts with panic. It starts with a small drop, 5%, sometimes less. Nothing dramatic, nothing that feels dangerous. Retail investors often see that drop as an opportunity. They buy the dip, they increase exposure, they add more leverage, believing the market will recover quickly. But behind the scenes, something else begins. Collateral values start falling. And falling collateral is the first crack in the leverage system, because leverage depends on collateral stability. If the value of the asset backing a loan drops, the lender becomes nervous. Risk departments begin monitoring exposure more closely. Margin requirements increase, borrowing conditions tighten. And suddenly, investors who were comfortable with their positions yesterday find themselves under pressure today. This pressure grows quietly until the first wave of margin calls begins. Now imagine a trader holding a large leverage position. If the asset drops 10%, the trader may lose 50% of their capital. If the asset drops 20%, the account can be completely wiped out. And when that threshold is reached, the system does not ask politely. It liquidates. Positions are closed automatically. Assets are sold immediately. And those sales push the price even lower. Lower prices trigger new margin calls. And new margin calls create new forced sales. This is why crashes often accelerate in stages. First, the market dips. Then the market slides. Then the market collapses. Because the leverage structure unwinds layer by layer. Now look at how institutions behave during this phase. Institutions monitor leverage across the entire system. They watch margin debt levels, they track volatility spikes, they analyze liquidity flows, and when leverage becomes excessive, they begin preparing early. They raise cash, they reduce exposure, they hedge positions. Retail investors rarely see these moves because institutions do not announce them publicly. They reposition quietly. This is the same pattern we discussed earlier with gold accumulation. When powerful institutions prepare for instability, their moves appear boring. They increase reserves, they increase liquidity, they reduce risk. Retail investors often interpret this behavior as unnecessary caution. But when liquidation cycles begin, that caution becomes power, because cash becomes the most valuable asset in the room. Cash allows investors to buy when everyone else must sell. And during margin call cycles, selling is not optional. It is mandatory. Now imagine thousands of traders experiencing forced liquidation simultaneously. Crypto markets, technology stocks, speculative growth companies. Assets that rose fastest during expansion cycles often fall hardest during contraction, because these assets attracted the most leverage, and leverage magnifies both directions. During expansion, leverage accelerates gains. During contraction, leverage accelerates collapse. This is why the phrase liquidation cascade appears during major market events, because selling becomes contagious. One liquidation creates another, and another, and another, until the system stabilizes. Now here is the part most investors misunderstand. Crashes are terrifying for those trapped in leverage, but they are extraordinary opportunities for those holding liquidity, because when forced selling dominates the market, prices detach from fundamentals. Good assets become cheap, strong companies trade at discounts, strategic investments become available. This is how wealth transfers during crises, not through prediction, through preparation. Those forced to sell transfer assets to those ready to buy. This has happened repeatedly across financial history. The 2008 financial crisis, the 2020 pandemic crash, even the crypto collapses during liquidity tightening. Each time the same pattern appears. Leverage builds during optimism. Leverage collapses during stress. Assets change hands, and those holding liquidity emerge stronger. Now consider what the current environment is showing. Debt levels remain historically high. Interest rates have increased dramatically compared to previous years. Credit conditions are tightening, and speculative leverage has not disappeared. It has simply moved into different markets. This means the margin call cycle remains a risk, not because collapse is guaranteed tomorrow, but because the ingredients remain present. High leverage, high volatility, fragile liquidity. These ingredients create unstable systems, and unstable systems break under pressure. Now think carefully about your own positioning. Are you operating with leverage? Are you depending on constant price increases? Or are you building liquidity and flexibility? Because when margin call cycles begin, flexibility becomes survival. Investors who can hold through volatility gain time. Investors who can deploy capital gain opportunity. But investors trapped in leverage lose control. Markets decide for them. And when markets decide, decisions happen fast, much faster than most people expect. The margin call cycle does not ask if investors are ready. It only asks whether collateral remains sufficient. And when collateral disappears, liquidation follows immediately. This is why experienced investors respect leverage. They understand its power, but they also understand its danger, because leverage is not just a tool for amplification, it is a trigger for collapse. And once that trigger activates, markets can move faster than human psychology can process. Right now, many investors believe volatility is temporary. They believe markets will recover quickly, and sometimes that belief proves correct. But history shows that when leverage unwinds aggressively, recovery is rarely smooth. It is chaotic, it is emotional, it is violent. And during that chaos, positioning determines outcome. Those forced to sell lose control. Those prepared gain opportunity. That difference creates the wealth transfer cycle we will explore next. Because every major crash in financial history has produced something remarkable. New billionaires, new ownership structures, new concentrations of wealth. And the investors who understand this cycle do not only survive it, they prepare for it. If you want to understand how crises repeatedly create enormous fortunes for those positioned correctly, subscribe. Because the next stage of this cycle reveals something even more important. Why every crash quietly transfers ownership from the unprepared to the prepared, and why that transfer may already be beginning again.